And I think the extreme monetary policy that we've had, I would say, in this century, and especially since the '08 crisis, is coming home to roost. Tuesday, September 14th, 2021, Maneco 64, home of alternative economics and contrarian views. So I've used the word crack up boom several times in the last few weeks. We've talked about hyperinflation, which of course is not an economy doing well and prices rising too quickly. Hyperinflation is the loss of confidence in the currency, in the fiat currency really, and it usually happens when central bankers and governments abuse their power to create fiat currency out of thin air. It happened in spades back during World War I and after World War I in Germany. And Germany and the Weimar Republic have become synonymous with a crack-up boom. In German, it's called the Katastrophenhause. Everything back in that period, post-war period in Germany from 1918 to 1923 was a catastrophe. A little bit like what we have today. Ever since, I would say, 2008, everything is a catastrophe, and especially since last year. And it's interesting that the country that you'd think would never make the same mistake again seems to be making the same mistake again. Yes, German wholesale prices rose by the highest level since 1974. And I would argue, though, that if the Bundesbank, which is the German central bank, and the Deutschmark, which was the old German currency that was created after World War II and given up for the euro in 1999, if that currency was still around and you had someone like Hans Tietmeyer, who was the president of the Bundesbank, around the time I started in this business, if we had that, I don't think we'd be seeing this kind of inflation in Germany or the consequence thereof, these rising prices. I don't think an independent Bundesbank, an independent Germany with its own Deutschmark would be doing QE, would have interest rates running at negative or zero. It's just crazy. And I think, yes, this crack-up boom is starting. Some people might argue that it's energy prices rising or car prices rising. And some people have very good information, but they call it commodity inflation. They call it car inflation, food inflation. There's no such thing as commodity or food inflation. And they say that, unfortunately, because they've been taught by the system that's run by the powers that be, by the central bankers who finance everything, not just the academia, but the mainstream media, the politicians. They trick people into thinking that all the problem is rising prices, that it creates inflation. No, it's the consequence of inflation. And I think the extreme monetary policy that we've had, I would say, in this century, and especially since the '08 crisis, is coming home to roost. We're not only seeing the beginnings of the rising prices, but eventually we will see the beginnings, if we're not already seeing people losing confidence in the currency. And that's why we're getting all the shortages of everything. That's why we're getting the labor shortages. That's why we're getting exploding wholesale prices in Germany and also exploding energy prices. We're going to go through that now. So first of all, I wanted to show you, they call it the WPI, Wholesale Price Index in Germany. It came out yesterday at 12.3%. Yes, you heard me right, 12.3%. And this chart goes back all the way to the early 70s. And as you can see, it spiked to the highest level since 1974. So a very long time ago. So what does 1974 bring to mind? Well, it brings to mind the stagflationary 1970s. And why did Germany let prices rise that much in the 1970s? Well, unfortunately, because the major fiat currencies are tied to the dollar. And if the dollar inflates, all the other currencies are going to inflate. But the German mark, or the Deutsche Mark, did relatively well compared to the dollar, though, in the 70s. I think in 1977, 78, the United States Treasury even issued Carter bonds, which were denominated in Deutschmarks and in Swiss francs. So, but this is quite amazing that we're seeing wholesale prices rise at double digits in Germany. And Germany, don't forget, is the biggest economy in Europe, and probably top 4 in the world. And I think a couple of weeks ago, I think it was the 7th of September, or maybe a week, maybe more, 10 days, I forget. I made a video about how gas prices, and by gas prices, I mean natural gas in Europe and in the UK, what Americans call gas, which is what they put in their cars, is actually natural gas. What we put in our cars is petrol here in England. But anyway, natural gas prices are going through the roof. And I'm going to put the video I made about that. I was already seeing trouble for the natural gas sector and energy sector. Natural gas is heavily used throughout Europe, and especially in the UK, for generating energy. Utilities use natural gas. And with winter approaching soon, it's going to get even worse, in my opinion. And I spoke about what's driving that. Apart from the inflation, we've got a policy by the powers that be, the globalists, of driving up carbon emissions prices, futures prices. Yes, they trade that. It's basically the climate change globalists' way of controlling the use of fossil fuels. And this emissions future has been going through the roof as well. And I think they're driving it up so that it's very hard for countries in Europe to substitute their natural gas for coal, because it becomes very expensive. Because utility companies, industrial companies in Europe now need permission. They need to keep their carbon consumption neutral. So the way to do that is through these emission futures, but emission futures are going through the roof. So they can't diversify away from natural gas, and it's creating a huge mess, which is probably by design. And I said in my video from 10 days or so ago that it was going to make the winter miserable for a lot of people in the UK and in the EU. And one of my viewers yesterday sent me a tweet by a guy called Javier Blas, and he's a correspondent for Bloomberg News, chief energy correspondent. And I've gone to his Twitter page, and he's putting out some good information about what's going on. Of course, he doesn't understand that this is to do with central banking policy. He calls it energy inflation or commodity inflation. He doesn't realize that this is the inflation, the extreme monetary policy coming home to roost. So what do I mean by coming home to roost? Well, it's the fact that you cannot expect things that are of utility to human beings, be it natural gas or other commodities or other things that we need to survive, to stay very low in value when the central bankers in the banking system are creating trillions upon trillions of worthless currency. No, it comes home to roost eventually. And that's what we're seeing right now. So I'm going to scroll down through his Twitter page. I'm going to put a link to it in the description, and you can have a look at it yourself if you're on Twitter. So he says, and this is about Spain now, Spanish Prime Minister personally announces a tax cut on electricity bills. A special tax on power goes from 5.1% to 0.5% to mitigate the impact of soaring wholesale prices. Madrid had already reduced tax on electricity a few months ago, a sign of growing pain in Europe. So at least there's a silver lining to this. They're cutting taxes. And then he says commodity inflation. So that's a mistake. He should use commodity prices. Of course, he's probably been educated in the Keynesian world, just like I was, but thankfully I woke up to it. The Keynesian economics that they teach in higher education. But he says multiple commodity markets have moved deep into demand destruction mode. He thinks it's going to destroy demand. It might destroy demand, but they're not going to keep, it's not going to make prices drop. Prices are going to rise even more because there's going to be less of it out there and people are still going to need it. It's a real cocktail for the crack up boom, I would say. So he says breaking the Bloomberg Commodity Spot Index has surged to a fresh 10-year high, surpassing the level reached before the summer break and fast approaching a record high. So I noticed the CRB as well is at a 7-year high. Gold and silver, of course, they're still languishing compared to commodities. Yes, last year they did very well, and since the period of from around 2016 to 2019, gold and silver is still a lot higher. And I think investors and speculators, traders, they still haven't realized that we are in a crack up boom and that things are not going to get better. We're not going to see prices go down. Even in a recession or a depression, they're going to keep going up. And when they realize that, you can bet gold and silver are going to go ballistic. You just need to be patient. So I'm scrolling down here on his Twitter. So Europe's energy crunch, this was about 18 hours ago, he says, and another milestone for the first time ever, Germany 1 year ahead electricity prices, a key benchmark, particularly for big industrial consumers, climb above the psychological barrier of 100 euros per megawatt. So this is not just a consumer that's going to get hurt with higher utility prices, but also industrial companies. And that's going to seep through the whole economy, just like oil prices going up in the 70s, seep through everything. And am I saying oil prices caused the inflation of the 70s? No, because if you've been listening to me, the inflation of the 70s started back in the 60s when the United States Treasury started its policy of war and guns and butter and didn't stop it. And the Federal Reserve helped along, and the US went off gold as well. That helped it inflate even more. They just use these commodities as an excuse so people don't put the spotlight on the real culprits, which are the bankers, the central banking system, the banking system, and the politicians who spend this phony, fake fiat currency out of thin air. That's why you have to try to be out of this fiat currency as much as possible. So another tweet here, gas market, another day, another record. Yes, we're way above 5 now in natural gas. And I lost count of how many days. European nat gas benchmarks, UK NBP and Dutch TTF up 5% on the day, trading at equivalent of more than $21 per MBTU. Since September 1st, European gas prices are up 20%. So I'm going to stop right here, and we're going to look at where the markets are this morning. You can have a look at these charts here before I go. Prices in the UK. Just look at these charts, courtesy of Mr. Blaz. We've seen in the last 12 months or more that first we had lumber, we have car prices rising, we have food prices rising, we've got shrinkflation everywhere. It's not going to stop. And for those people who think that these rising prices are going to stop if the economy goes again into lockdown or slows down again, you're deluded, because you were saying last year that we wouldn't have the rising prices or inflation because we've had lockdowns and everything was, people weren't spending. But look what we've had. So I think it will be even worse if we go into lockdown again. And I saw a headline today when I logged in. And usually I don't look at this. It's news from Apple, and it says the pandemic is far from over. This is Sky News. PM to unveil winter plan to fight COVID-19. So there you go. But that's not going to improve anything in terms of prices and the crack up boom, in my opinion. So let's look at where we are right now. I'm a little later today. It's 5 to 9 a.m. London time. Just before I start, actually, I went to play golf yesterday. Maybe you don't know, but I played golf yesterday afternoon. It was a very nice day, unlike today. It's rainy. And I took a Snickers bar with me because we had breakfast before we played, but you kind of get hungry during the round, and I opened the Snickers bar around the 10th hole, and I realized this is really small. It's gotten really small. I hadn't had a Snickers bar in a long time, so there you go. That's shrinkflation. So right now we've got spot gold at $17.90.50. It's down $3. High's been $17.95. And the low $17.88.90. Silver is down 3 cents at $23.70. High's been $23.78 and the low $23.63. Yes, I noticed gold did fairly well yesterday. Silver got smashed on the COMEX Open. I wasn't watching it. I was just playing my golf. But yeah, I noticed that we dropped down to like 23.38. And then it rebounded right back up. But they kept the lid on silver all day. But I noticed that the mining stocks did fairly well yesterday. So that's a sign, short-term sign maybe, that things are improving. But as I've said, it's the biggest mistake right now, if you have physical gold and silver, to get rid of it. Of course, you might have an emergency and you might need it, because it's just like savings for a rainy day. But I think it's going to be, as I've said many times, the biggest bull market or the biggest bear market in fiat currencies. The opposite will be the biggest bull market in precious metals, and we're seeing as well in commodities. So I noticed as well yesterday, I was home already, that the stock market had a little bit of a Hail Mary rally finish in the last hour, and they managed to goose up the stock markets. But this morning, the Dow futures is only up 15. The NASDAQ futures is down 15 points, and the S&P is unchanged. So to the currencies now, we've got sterling up 0.25% at 138.75. I think we had some jobs numbers in the UK. I think they're all pretty much fake. But anyway, the euro is up 0.1% at 118.24. The dollar is unchanged, trading at 110 exactly versus the yen. Dollar is down slightly versus the yuan at 643.87. What about Evergrande property development group in China? Yes, it could be a big problem, especially to foreign investors in their bonds. And I'm going to be talking probably about that later on today. I'm interviewing London Paul from the Serious Report. I will probably be publishing that interview later on today. And we will talk about what's going on in China and also the bigger picture, the geopolitical, economic, social view that London Paul has. So let's continue with the FX update then. Aussie dollar is down 0.25% at 73.50. The dollar is unchanged versus the Canadian dollar at 126.43. And the Kiwi dollar is unchanged as well at 71.23. WTI crude continues to move higher. I think we were trading around 70 yesterday when I was recording my video. Right now we're at 70.90, up another percent. So the high, yeah, we're right around the highs here. We've got high grade copper down 0.2% at 433. Natural gas is down 0.4%, but yesterday I think we were below 5 when I made my video, and now guess where we are at 522. So this is another 7-year high. The 5 level is very important. And look at this chart, how much more room natural gas has on the upside. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to this channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.